Just weeks ago, the US Federal Reserve felt so good about the trajectory of inflation, it hinted it was ready to cut its benchmark interest rate potentially 3 times this year. The Fed has been raising that rate to drive down inflation, which ran out of control in the summer of 2022. But now the alarm bells have been ringing so much, the Fed has backed off raising that rate. So the Fed has left that benchmark interest rate at up to 5.5% for now. And that interest rate influences the cost of credit, particularly mortgages, which are now so elevated, they're beyond the reach of many buyers, particularly first-time buyers in the US. So there's big pressure on the central bank to begin cutting that rate. The Fed's problem is somewhat understandable if it's been caught flat-footed. Economic indicators at the start of the year were looking very good. Growth was so good, it was revised upwards by the International Monetary Fund. Unemployment remains at historic lows, and consumer spending has been robust, despite the fact that the cost of consumer credit has remained elevated for a couple of years or so now. And while consumers are still spending, there's concern about that persistent inflation in things like services, particularly the cost of eating out. And the Fed has an existential crisis of its own as it tries to juggle this dilemma about when to cut interest rates. Republican presidential nominee Donald Trump has indicated that should he win November's presidential election, he wants to take a more active role in the setting of the Fed's interest rate, upending decades of convention that the president should leave the Federal Reserve completely independent to do its work alone. Owen, Fairclough, CGTN, Washington.